The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It is time to talk about money. You know, at the end of the year or the beginning of a new year, I always talk about what I foresee for the coming year. And that's something that is normal. It's something that most people do. But in that, I'm a long-term investor, and I look at long-term themes. So there is a time to look at a mile-high view of where things are headed. And I talked during the year about these themes, and I'd do one week and another couple weeks later and whatever. But I thought it would be great just to spend this time talking about the mile-high view of where we're headed. There's three themes. You know, with the Dow finishing 2017 at around 25,000, it's not just a once-a-year deal. It's a long-term. Annual projections are the short-term part, and the long-term is much more. You know, on May 21st of 2010, I came out with the first theme called Dow 100,000. You know, the secular bull market, I said there was going to probably be a secular bull market. Actually, I raised a question. Are we at the beginning of secular bull market? On that May 21st date, 7 years ago, 8 years ago, it's now been. The market stood at 10,193 on that day. And I said, I think the Dow could make 100,000. And I've repeated that a few times a year since then. The second cycle is the reason why I believe that we are in a secular bull market and what's driving things forward. And that was a study that was done by Standard Chartered Bank out of the UK. And on February 3rd of 2012, I talked for the first time about the super cycle. The Dow stood at 12,862. It had already gone up 2,700 points from the time I said Dow 100,000. But on February of 2012, I said, I believe that the super cycle is the reason that we're in a secular bull market. And a secular bull market that's going to last more than a decade, maybe 2 decades before it's over with. And then the third theme was, if we're in a secular bull markets sometimes come to an end. How is it going to come to an end? I don't believe it's going to come to an end, or the highest probability is it's not going to come to an end like the Great Recession. I think it's going to come to an end in a very different way. I thought it's going to come to an end with a real uptick in inflation. The high inflation numbers that we had in the 1970s. At the time I said that, that was actually March 17th of 2016, the first time I said it. The Dow stood at 20,914. Looked a whole lot better that we're moving closer to 100,000 when the Dow was at 21,000 than when it was at 10,000. So I want to pick up on those. I want to go back, start with the first of those themes, and those three themes are running concurrently. They're running all the time. It's what underlies my projections for the year. It's what underlies my portfolios. And as long as I continue to see reason that those are valid, I will continue to talk about them during the year as well. But I want to put the three together today just so we put the whole picture together. The whole picture. It's the roadmap. It's when you're starting out, and if you're driving across the country, if you're driving from Seattle to Boston, for example, you know what the end point is? You know how you're going to get there. You know the roads. But you start by making that first leg of the trip. That's the annual projection. Now I want to talk about the trip itself. You know, I said on May 21st of 2010, I was a believer that history doesn't repeat, but that it rhymes, and that there's lessons to be learned from previous markets. The Dow stood at 10,193, as I said before. And I said, you know, if you look at 1966, the Dow was at 999.9. You could say the Dow was at 1,000. But if you go back before 1966, the Dow from 1942 was approximately 200. It was a five-fold increase from 1950 to 1966. I almost said 2066. I got a little ahead of myself there. You know, if you go back to the 1940s and 41 or 42 when the Dow stood at 100 before World War II, it was a period of 25 years that the Dow went from 100 to 1,000, a tenfold increase. And you think about that strong bull market, it was a very strong bull market. There was new technology. There was a lot of consumer demand. You had housing that was being built, GI housing. You had World War II and the war costs, and you had the GIs coming back from the war, going back to school, getting educated. We were in a process of building, and that building was something that took the Dow from 100 in 1942 to 1,000 in 1966. But in 1966, it reached a peak. And in 1966, it peaked at just under 1,000, a tenth of a point under 1,000, and it started to fall, and it fell down 20%. By the fall of 1966, the Dow had reached closer to 800. But then a rally began, and the rally lasted until late 1968. And that rally again took the Dow to 1,000. And in late 1968, the market turned once again and started to fade until the mid-1970s when it was down 30%. Another rally started in mid-1970 that took the Dow back to 1,000 in 1972. By the end of 1972, the Dow was once again at 1,000, and then it rolled over. And by mid-74, 2 years later, the Dow was down 40%. So the Dow had gone to 1,000 in 66. It had gone down 20%, rose back to 1,000, then fell by mid-74, down 40%. And now it began in early 75. It started back up again, and it reached 1,000 once again. But by 1978, the Dow had faded again down to 780. Then something happened. The Dow turned around and started up to 1982. And a lot of people were predicting that the Dow had once again run up against that 1,000 mark, was going to come down. There were a number of short sellers that said, you got to go short the market. You're going to only make money if you sell the stocks now, buy them back at a much lower price. The Dow hit 1,000 in August of 1982, and it kept going. It kept going to 10,000 from 1982 until the end of the century. From 1982 to 2000, the Dow went from 1,000 to 10,000, a tenfold increase. So if you look at it, 1942, 100 to 1966, 1,000. Then from August of 82, from 1,000 to 2000, it rose to 10,000. Two tenfold increases. And so back in that time, in 2010, I said, you know, history doesn't repeat, but it rhymes. And here we sit with a market which has gone up and down. In March of 2000, the Dow was over 11,000, and it hit a brick wall. By September of 2001, it was at 8,800. It had gone down 20%, and it rallied back to 10,000, if you remember, by early 2002. And then it dropped to 7,500 by 2002. And again, in 2003, it rallied to 10,000 in September of 2003. And then October of 2006, it got all the way to 12,000, and then it rolled over. Actually, it continued from October of 2006 to 14,000 in October of 2007, and then it went down. And by March 6th of 2009, it got to 6,400, 6,443. And I said, it was a similar kind of time that we saw in the 1966 to 1982 time period. And here we were again. Had somebody gone away and looked at what was going on from 2000 to 2010, had they gone off hiking in the Himalayas or being completely off all news, they'd come back and said, gee, for 10 years the Dow has just been straight. No, it hadn't been. It had a few ups and downs, just like it did, 66 to 82. But the Dow had those times. We're coming to a break. I'm going to come back and talk about these three themes once again. Don't go away. We've just gotten started. We've got a lot more to cover.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
I've been talking about the three themes that guide my overall strategy for putting together portfolios and investments. And those three themes have been active for a number of years. So I wanted to pull them all together. I've talked about one at a time every once in a while, but I wanted to put the three together, and I'm doing that today. And I talked about the first theme, Dow 100,000. Back in May of 2000, I said I believed that the Dow would get to 100,000. Didn't say a time frame, but I believe that we're on our way there. All I had were looking at the patterns and the cycles. I said history doesn't repeat, but that it rhymes. We'd had a tenfold increase from 1942 to 1966. From August of 82 to 2000, we'd had another tenfold increase. I wasn't going to be surprised at all in 2010 if we reached from 10,000 to 100,000. The Dow, when I first talked about it, stood at 10,193. I thought we could reach 100,000. And there was one other point I brought along, is if you look at the 20th century, you know, we went through a Great Depression. We went through numerous recessions, the 1960s, 80s, 1900s. In between, we went through 2 world wars. We went through the Vietnam War, the Korea War. We went through multiple conflicts. We went through communism and the Cold War. We had 2 presidential assassinations. We had large problems like Chernobyl melting down and a multitude of problems in unpredictable things happening. And with all the negatives, the Dow went from 66 to 400, or from 66 on January 1st, 1900 to 11,467 by the end of the century. I said, that's a basis. Looking at all those issues we went through, we've seen a tremendous growth. So that was the first theme. The second theme I started talking about on February 3rd, 2012. The Dow had already reached 12,863. It had come up almost 2,700 points. And in November of the previous year, November of 2011, Standard Chartered Bank out of the UK, 1,700 branches, 80,000 employees, they did a report on a super growth cycle that was just beginning. November 2011, they said it was a time in which the world GDP grows faster than average. You had faster growth. The first cycle, they said, was from 1870 to 1913. It lasted for 43 years. And it was driven primarily by the industrialization of the United States. Now, I've also talked during that period of time, the U.S. went through some very, very difficult times. From 1874 to the early 1900s, we went through a time like 2008, 2007, 2009, only it lasted for almost 30 years. 30 years. Think about what that was. But in the 1870s, half the people were employed on the farms. We were an agricultural nation. By the early 1900s, we had converted to an industrialized nation. From that time, it was a very painful time, we didn't keep statistics on unemployment, but unemployment probably reached 20%. But during that time, we made a significant change. It was a powerful growth in terms of where we went. That was the first cycle, driven primarily by the industrialization of the U.S. The second cycle was from 1945 to 1970. World War II had come to an end, and that was driven primarily by the rebuilding of Europe and Asia. It was a pretty benign period of time for business cycles, but you had growth in wealthy countries like the U.S. and UK and France and Germany. The Dow went up significantly during that time, went up tenfold almost during that period of time. But that was also a time when you had the death of the colonial system. You had all those colonial nations become independent countries. You also had the start of the Cold War and the buildup, military buildup. You also had the infrastructure taking place in the U.S., building the roads, building the airports. All that was taking place during that period of time. You had the GIs returning from World War II and the education taking place. They went back to school. There were GI houses. I grew up in one of those little houses, small 1,200 square foot house that had 2 bedrooms, a living room, and a kitchen and a bathroom. That was the house. It was square, essentially square. Those were the GI houses that were built, and it was a housing boom as well. All that happening during the second cycle. And Standard Chartered Bank said in 2009 we began a new cycle that was going to last beyond 2030. Another 10 years beyond, 12 years beyond where we are today. And they said that it was going to be driven primarily by the emerging countries, especially those in Asia. The winners were going to be global winners. It was going to be China and India and Brazil, Indonesia, Russia, Turkey, Sub-Saharan Africa. And while that was going on, like the other times, there were going to be big risks, political and social volatility. You know, we've seen that with Arab Spring. We've seen that with the down markets in Russia and in Brazil. We've seen those times happening. But you know, every super cycle had its share of winners and losers. The first super cycle, the loser in the U.S. was agriculture. You know, the people moved from the farms in. Although while agriculture in itself, the total output increased, the number of people employed, and the businesses that catered to agriculture changed. You know, investing is not a zero-sum game. If you look at the stock market, it's not flat. It's gone up. It's not a one-size-fit-all. You know, that's what I said. It was going to be an exciting time. I'd already talked about Dow 100,000 several times. We'd gone through black swans, talking about black swans, not just the negatives, but the positives as well. We had talked about how to get through all this period of time, but the times, they were a-changing, and we were seeing about that. And as that theme developed, other themes came in. It was about the math and world income. What was driving the supercycle? What was going to drive the emerging nations? And a lot of that was the emergence of the middle class worldwide. I went back to 1820s. 94% of the world's population lived in poverty. In today's terms, that's $3.10 per day income. That's right, $19 per month. In 1820, 94% of the world's population had an average income of $19 per month, $228 per year. Not in $1820, but in 2016 or 2000, actually that was $2012. $228 is what the average person had as income. Life expectancy was 37 years. Most people lived on the farms, and so they raised their own food and they did their own work. You know, as we got to the 1870s and the beginning of the first supercycle, already the number of people living in poverty had shrunk from 94% to 87%. Half of the population around the world lived on farms, and most of the towns were less than 2,500 people. In the U.S., labor prices had increased, and we were starting to see the industrialization of the U.S. Already incomes were increasing, and they'd gone from $228 per year to $282. You know, still, shoes, for example, were made, and shoes were the same size for everybody, and there wasn't a left and a right shoe. The same shoe was used for both left and right. Dinner consisted of things like chicken stew, dumplings, mashed potatoes, biscuits, and honey. There were no salads, very little fruit. Life expectancy had increased from 37 to 44 years. We lived with smallpox and cholera and TB and yellow fever. Medical kits, the ones that doctors carried, the black bag, were primarily saws and knives for amputation. That was 1870. By 1950, the U.S. was really moving through this first supercycle in industrialization, and 82% of the world's population was in poverty. But in the U.S., incomes had increased from $282 in 1870 to $1,340, $8 an hour in today's terms. Shoes were being factory made, there were right and left shoes, foods varied, and life expectancy had increased to 53 years of age, up 16 years from 1820. The U.S. was beginning to move from poverty to a middle class. The world still, 82% poverty, subsistence. They weren't consumers. And by 1945, most of the world was still poverty-stricken. 73% of the people were in poverty as the second supercycle and the rebuilding of Europe. But that would start to decline through that second supercycle, and the big decline began in 1960, which today we have fewer than 20% of the world's population. Still a large number, but we've moved a lot of people into consumerism from subsistence. That's a significant factor as we talk about what's happening with these emerging nations. They're getting their middle class, just like Europe did, just like the U.S. did. they're becoming consumers, and that consumers creating demand. We've got more to talk about. Don't go away. We're just getting really started. I'll be right back after the commercial.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I've been talking about the three themes which underlie the strategy for me building portfolios. I'm a long-term investor, so I'm looking at a long-term strategy. The first theme, of course, was Dow 100,000, because I believe we're in a secular bull market. We're going to reach Dow 100,000. I talked about the first part of the program, why I started that. I first talked about that in May of 2010. The second theme is what drives that market is this whole idea of a super cycle, a time at which world GDP grows faster than average. First super cycle, 1870 to 1913, driven by the industrialization of the U.S. Second super cycle from 1945 to 1970, driven by the rebuilding of Europe, the decolonization, rebuilding of Asia as well from World War II. The third super cycle began in 2009, according to Standard Chartered Bank of the UK, and is driven by emerging nations. But it requires, I talked about the change that's happening with consumerism. 93% of the world's middle class is expected by the year 2020 to be in those emerging nations. We're seeing the disappearance of poverty, defined in 2012 terms as $3.10 a day. That's in 2012 dollars. We're seeing that disappearance happen. Less than 20% of the world's population today lives in that kind of poverty. We'll see that continue to disappear. But the other thing is to continue to grow, as we have in the U.S., requires capital. And to explain that, I talked about a time that began in 1957. Ken Olson and Harlan Anderson, engineers at MIT Lincoln Lab, were building a machine where operators had controls over the program. They had a business plan, but no one was really interested in funding what was a computer company. Can you imagine today? No one was interested in that. There had been some small companies that had tried and failed. RCA had funded one of those. GE had funded one of those. They failed. But there was a guy who began his career at Harvard in 1926, George Doriot. And in the first supercycle, the money that was created and the capital that was provided was primarily by individual people who put up money that made a lot of wealth in steel or some other way, and they began to put up wealth. But by the early 1960s, there were fewer and fewer more angel investors, but not big enough to fund some of the startups. But George Doriot founded a company called the American Research and Development Corporation, and he brought together some formal angel investors, put them together, and they invested in a new computer company. They put in $70,000 combined into a company called Digital Equipment Corporation. And when Digital Equipment went public and issued stock to the public, that $70,000 became worth $38 million. And thus was born venture capital. That really launched the venture capital industry. By 2015, companies founded by entrepreneurs, small guys, backed by venture capital, were creating almost 15 million jobs a year. Those companies generated $4.3 trillion in revenues. Over 20% of GDP was coming from companies that had been funded by venture capital since the 1970s. In 2013, over 40% of R&D was happening in those small independent firms. From zero R&D in 1979 to over 40% of all R&D that was being funded. You know, the Stanford Business School looked at it and looked at the companies. 43% of the companies that came public were financed. From 1979 to 2015, 43% of the companies were funded by venture capital. They represented 57% of market capitalization, 38% of the total companies, or 38% of the total employees, and 82% of R&D of all the companies that came public from 1979 to 2015. That's the impact. You can think about it. You know some of them, Microsoft and Apple and Qualcomm, Intel. Those are companies that were financed by venture capital. They tend to, while large companies tend to make improvements to existing products, innovative companies make disruptive technology, unexpectedly displacing existing technology. And that meant that those companies grew very fast. William Nordhaus of Yale said 70% of the goods and services that existed in the year 2000 did not exist in the year 1900. My guess is that 70% of the goods and services that will exist in 2060 don't exist today. And maybe you can back that down to 2050. But venture capital is now primarily for large companies. And so I started talking about how do you fund smaller companies? And I believe the answer is crowdfunding. Online funding for as little as $1,000 and ownership. And anyone from anywhere in the world can own it. There's over 2,000 crowdfunding sites, and it's probably grown since I first talked about this in 2016. Over 2,000 crowdfunding sites. The average amount invested is $7,000. The average time from the time a company goes on a crowdfunding site until it's funded is like 9 weeks. There were 2 years ago 350 projects being started every single day. In the U.S., in 2 years ago, 15,515 campaigns were underway and raising an average of $31,000. Most likely person to invest in those, they were between 24 and 35. People over 45, very unlikely. People were investing in crowdfunding. By last year, venture capital raised less money than crowdfunding. In 2010, crowdfunding raised a total of $880 million. 880. By 2014, that had grown to $13 billion. And by 2015, to $34 billion. The forecast is that by 2025, crowdfunding will raise $300 billion, almost 10 times what venture capital raises. That is the reason that companies, I believe, will be funded going forward during this time of expansion, during this time when we see Dow 100,000, during this super cycle period of time. And it's not just companies in the U.S. that will be funded. It's companies worldwide. And as we look around, the world has become flat. There was a period of time when information existed and was controlled, when you had proprietary information. Today, with the internet, the world truly is flat. People in Kenya have access to information that in our libraries, in our research facilities, that would not have been available just 25 years ago. The world is growing, and the world is growing very rapidly. And the existence of companies is decreasing at an ever faster rate. Professor Richard Foster of Yale said that has calculated a company that became a member of the Standard & Poor's 500 in the 1920s had an average life expectancy of 70 years. Today, the average lifespan of a company in the S&P 500 is approximately 15 years, and that's probably going to shorten. Think about it. It took Microsoft 14 years to go from no revenues to 1 billion. It took eBay and Facebook 7 years to go from 0 to 1 billion. It took Zynga 4 years to go from 0 to 1 billion. And yeah, Zynga's fallen on hard times, but it represents what's happening today. And I believe that those things are driving us during this supercycle. And we will see this supercycle underlying this whole concept that I have of down 100,000. But it won't go on forever. There is a time coming when secular bull markets come to an end. We saw that in 1966 when that Dow had risen from 100 to 1,000. We saw that flat period of time from 1966 to 1982. We saw in 82 to 2000, the Dow going from 1,000 to 10,000, and that slowed down. I think we'll see it slow down again. And the reasons, I'm going to talk about that, something that I've been talking about for a couple of years. Don't go away. We're coming to a commercial break, and right after this commercial break, I want to talk about how I see this coming to an end. That's the strategy underlying what I do. Don't go away. I'll be right back after the commercial break.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and probably, most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019 or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So, I've been talking about the three themes that underlie the strategy for me building portfolios. And I'm a long-term investor. I've done very well. My returns are published. We're about to have a new website that we launch. We got hacked and people shut down essentially our website. We've got something that's working, but in the next 2 weeks, next short while, you'll see our website up again. But I've been talking about three themes, and those three themes underlie where we are and what the strategy is. The first theme was Dow 100,000. The second theme I just finished talking about was what underlies that, the supercycle, and why the supercycle is reasonable. But both secular bull markets come to an end. They did in 1966. They did in 2000, March of 2000. I believe this one will end as well. And the question is, how will it end? We can't predict when. We can't predict how exactly. But we can begin to prepare for it. And I don't believe that we'll see it end with another great recession. I believe that we're going to see it end in a very different way. Doesn't mean it will, but I think the highest probability is, and I think the highest probability is we're going to see high inflation. It's a gradual kind of thing. It's the frog sitting in water story. Drop a frog into boiling water, they'll hop out right away. Drop a frog into cold water and slowly heat it up until it boils, and the frog will sit there the whole time. I'm not sure that that's really true, but that's the way the story goes. Anyway, with inflation, if you look at what happened in the 1960s and 1970s, people really became aware of inflation in the early 70s or mid-70s, but it really began in the early 60s. 1962, inflation was 1%. By 64, it was 1.3. By 66, it had risen to 2.9, 67, 3.1, 68, 4.2, 69, 5.5, 70 was 5.7, and then we got into the recession of 1971 when inflation dropped to 3.2, and in 73, inflation kicked up to 6.2, and 74 to 11, 75 to 9, and by 79, inflation reached 11 again, and it was at 13 by 1980 before we started bringing it down. I believe that if you look back, that my parents went through the Great Depression, and when they came into power, when that generation came to power, they focused on making sure we would not have another Great Depression. So when the economy started, we had inflation starting up, and instead of dealing with inflation, they began to make sure that the economy would not go negative and go into a Great Depression. They were willing to inflate their way out of it. When the generation went through the inflationary period, came into being, we set limits on how much inflation we wanted. And we were willing to risk the Great Depression to get out of it. I think we're headed that way. And I think part of that is, if you look at what has just happened, the new head of the Federal Reserve is Jerome Powell. Now, Bernanke's research and expertise was on the Great Depression. And so when we went through the Great Recession, he knew how to deal with it. Powell, on the other hand, is an expert on banking regulation. What happens if we pick up inflation? Will he know really how to respond? When we hit the 70s, we went into a period of stagflation, and I believe we had the wrong person as the head of the Federal Reserve. From 1951 to 1970, William McChesney Martin was head of the Federal Reserve. He was in charge of what was going on, the Council of Economic Advisors. He had served Truman, Eisenhower, Kennedy, Johnson, and Nixon. Head of the Federal Reserve. He had been educated at Yale in English and Latin, not in finance. He'd gone to work for A.G. Edwards, got a seat on the New York Stock Exchange in 1931, in the middle of the Great Depression. And his focus was on regulation of the stock market, not on the economy. And he did actually begin to tighten the monetary policy in 1969 at the beginning of the recession. But when Nixon came into power, as Nixon was concerned about the economy, concerned about election, he appointed Arthur Burns to replace Martin. Burns had been educated at Columbia. He taught at Rutgers from 1927 to 1944. He taught during the time of the Great Recession. He lived during the Great Recession. Like Martin before him, Burns was looking at the Great Recession. His expertise was in business cycles, and he reversed the tight money policy that Martin was doing, and he was pushing business expansion because, looking back at his experience, he could see recessionary pushes can push you into a Great Depression. He was not willing to do that. He wanted to press expansion, and he followed the policies to do that. You know, that's how we got into that inflationary period of time. We came through the Great Recession because we put limits on what inflation we would do. Now, we're in a new time. Powell, the head of the Federal Reserve, is not an economist. He's an attorney, a lawyer. He worked as an investment banker. Twice before we've had attorneys, lawyers as federal chairman, and it wasn't a good thing, either one. Maybe Powell, during this time, it will be different. But my concern, it's not going to be different. And as you look at inflation, it's driven by two factors. It's driven by commodity prices and by labor rates. Labor rates control about 2/3 of inflation as a rule of thumb, and commodities about 1/3. What we've seen is a low period of time of commodity prices beginning to rise, and we're seeing wage pressure as well. We're headed toward a period of inflationary times. Will they really control it, or will they allow it to go? If we hit a recession, will they try to push the business cycle, or will they allow it to go? You know, 2017, the Dow ended around 25,000. I believe we're in a long-term secular bull market. Through corrections we'll go. But over the long period of time, I believe we're going to hit 100,000. I believe it's driven by a super cycle that began in 2009, will probably last through 2030. During that time, there's a lot of money to be made, but it's also time to be prepared for how it will end. If you prepare too soon, you lose out on the increase in values. If you prepare too late, you get hammered with inflation. That's the underlying story of what's going on. That's what guides the investment philosophy and strategy. Year to year, there's positive things going on. But right now, it's a time of looking at a long-term investment strategy. And that wraps up the show for this week. Have a great weekend. Have a great week. And I will be back to talk about money next week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on AdamsFinancialConcepts.com. That's AdamsFinancialConcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts.
1300 KKOL.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com. The following program sponsored by